board. Okay, guys, so we are starting this chapter 4. Now, I will tell you, it's going to get easier. The first 3 chapters, especially chapter 3, was a challenge. This chapter is going to focus primarily on cash and internal controls. So, one thing I would like you guys to do is, if as I'm going through, there's any questions you have, please unmute your microphone and interrupt me, because I want this to be a scenario where you get your questions answered right away. So we are talking about related to companies, the importance of having internal controls in place. So we know with accounting, we know our goal is to gather information regarding a company in the form of external transactions and record them and ultimately communicate that to the end user in the form of financial statements. Now, financial statements, it's crucial they are correct. And there are reasons we may have incorrect financial statements. There can be honest errors, accidental errors in recording transactions or in applying accounting principles. So that's life, that's going to happen. Fraud is when a person intentionally deceives another for personal gain or to damage that person or company. Occupational fraud is the use of one's occupation for personal enrichment through the deliberate misuse or misapplication of the employer's resource. Fraud is something companies can and need to be able to control. And the way they can stop it is through internal controls. So if you've ever heard of the fraud triangle, basically, for fraud to occur, there must be 3 elements. There must be an opportunity for the fraud to occur. The situation allows the fraud to occur. That is the only piece in the fraud triangle that a company can work to minimize. The rationalization is the justification for the deceptive act by the one committing the fraud, and the motivation. Someone somehow feels the need to commit fraud. They might need money. So the motivation and the rationalization is within that person. You can't fix that. A company can't fix that. But what a company can attempt to eliminate is the opportunity for the situation to occur, which is why we're talking about internal controls. Internal controls attempt to eliminate the opportunity element of fraud. What internal controls will do will be safeguard the company's assets and ultimately improve the accuracy and reliability of accounting information. Back in 2002, 21 years ago almost, Congress came out with an act called the Sarbanes-Oxley Act. And this act basically was a result of a ton of various fraudulent companies basically going down. becoming non-existent due to the fraud that occurred within the company. So because of just several big fraud companies, they came out with an act where they, Enron and WorldCom were some of the big ones. So they came out with an act that was basically focused on public companies, those companies that are required to report their financial statements to the Securities Exchange Commission. So those that have stock on the national exchanges. And it provided information regarding how they need to test for internal controls, and how the auditor needs to report on their internal controls. And it also tightened up the relationship between the client and the auditor. So there was a lot that went into play with the SOX Act, Sarbanes-Oxley, we call it SOX Act. And internal controls, as you can see down here, the section 404 of this act required that company management document and assess the effectiveness of all internal control processes that could affect financial reporting, and that company auditors express an opinion on whether management's assessment of the effectiveness of internal controls is fairly stated. So again, companies that were not regulated by the SEC, this wasn't required for them, the SOX Act. The accounting scandals in the late 90s and early 2000s is what got this Sarbanes-Oxley Act passed. SOX sets forth a variety of guidelines related to the auditor-client relationship and in relation to internal controls. So guys, our first question of the day, which of the following statements is not true of the Sarbanes-Oxley Act of 2002? A, all companies in the US fall under that? No, that is not true. B, it helped establish guidelines for internal control procedures. C, it helped establish corporate executive accountability. Or D, it helped establish guidelines for auditor-client relations. What's not true, I guess I read that wrong. B, C, and D are true, but not all companies fall under its provisions. Remember, it is only companies that have to file financial statements with the Securities and Exchange Commission. Okay, any questions on this before we move on? Okay, so as you see here, this shows the hierarchy of how companies go about implementing internal controls. There we start with, at the bottom, the control environment. So every company has just a tone, the overall feel of how they handle even sales, how they handle ethics. So we call the control environment the overall ethical tone of the company with respect to internal controls. Often companies have formal policies related to management's philosophy, how they assign responsibilities, and they provide you with an organizational structure of who the hierarchical flow of the company. That begins the basis of a company's control environment. From then, we can see a risk assessment, which basically looks at this particular company and it identifies internal and external risk factors that could possibly be a problem for within that company. So I just think of this is so simple, but let's think of a casino. A casino operates different from a CPA office. So with a casino, they would really need to look and say, okay, where do we have problems, or where could we potentially have problems here? And as a result of just the pure cash that is being handled within a casino, they need to find ways in which they can control the issues that can happen as a result of so much cash. That's just an example. They need to look at their particular situation and look at where are we at risk. From there, companies establish control activities. These are the procedures and the policies that help ensure that management's directives are going to be carried out, such as authorizations, reconciliations, separation of duties. So, for example, not everyone at this casino will handle cash. Cash is handled by a few individuals, and those individuals are probably monitored in multiple ways and also with cameras on all activities that they are performing. Then once these control activities are in place, there needs to be a monitoring of those activities and seeing, hey, what's working right? What's working wrong? How do we fix this? So monitoring includes formal procedures for reporting any control deficiencies. Here you see Regal Entertainment Group talks about their internal controls and what they do in order to, in this case, to look at the internal controls. So here we're going to talk about a movie theater. In this case, preventative controls, such as separation of duties. The employees that sell the movie tickets should not also account for the cash at the theater. So the person that's actually selling them at the end of the night, there should be someone else that totals the cash. Physical controls. Concession supplies should be kept in a locked room with access only to authorized personnel. Proper authorization would be theater management should be authorized to make purchases, over a certain amount. Not anyone can just make purchases. And then employee management. Employees should be made fully aware of the company's internal control procedures, ethical responsibilities, and channels for reporting irregular behavior. And then in terms of e-commerce, there should be firewall settings so people can't have access into their system. Now, detective controls, reconciliations. Management should periodically determine whether the amount of physical assets the company has agree with the accounting records. Performance reviews. The amount of concessions sold should be compared with the number of tickets sold over a certain time frame. And then audits. So hiring an independent auditor to assess the theater's internal control procedures and detect any deficiencies or fraudulent behavior of employees. So here, the CEO and the chief financial officer, through SOX are required to now sign a report each year that certify the internal controls are in place, they're adequate, and they are working effectively. The auditors, the external auditors, are also required to provide an opinion on management's assessment of internal control over the financial reporting. And then they're required to provide their own opinion regarding the company's internal controls over financial reporting. So guys, what do you think of this one? Can someone read it and tell me what the correct answer is?
B.
Okay, will you read it out loud so we can?
Physical control.
Okay, so if a company places cash receipts from the day in a safe or bank deposit box, this would be an example of physical control. Excellent. That is correct. So guys, we are going to take a look at this problem. Below are several statements about internal controls, okay? The components of internal control, and we need to say, is it false or true? So who wants to take this first one? The components of internal control are built on the foundation of the ethical tone set by top management. True or false?
True.
True. Yes. Once every 3 months, managers need to review operations to ensure that control procedures work effectively. What do y'all think?
False.
False. It needs to happen more often. I didn't talk about collusion yet. So collusion refers to the act of a single individual circumventing internal controls. Collusion is when 2 or more people come together and circumvent internal controls. Collusion's tough because if you get a couple people that come together, you could have some issues. So I answered that one for you. Detective control procedures are designed to detect errors or fraud that have already occurred, while preventative control procedures are designed to keep errors or fraud from occurring in the first place. What do you guys think?
True.
True. Excellent. Okay, excuse me one sec. Got it. Okay, next. Fraud committed by top-level employees is more difficult to detect because those employees more often have the ability to override internal control features.
True.
It is true, guys. Yeah, you know, a lot of times those top execs can cause a lot of harm. A good example of separation of duties would be having one person collect cash from customers and account for it, while having another person order inventory and maintain control over it. What do you guys think? False. You should have one person collect the cash and another person account for it. And then one person orders inventory, another person maintains control over it. Separation of duties. Okay. Next, employee tips have historically been the most common means of detecting internal controls. Do you guys know? It's true. It is true. It is crucial that employees have the ability to call in concerns, because that is how most of fraudulent behavior is reported. Detective controls include reconciling the physical assets of the company with the accounting records and comparing actual performance of individuals or processes against their expected performance.
True.
True. Okay, guys, this last one is tricky. Effective internal controls and ethical employees ensure a company's success.
False.
False. You know why it's false? Yes, you want good internal controls. But for a company to be successful, you need a heck of a lot more than just good internal controls. You need a good product. You need a market to sell it. I mean, there's just a lot of items that go into play for a company to ultimately be successful. So, an effective internal control system can't turn a bad employee into a good one. And collusion is a problem. Even with internal controls, they're susceptible to collusion, because if two or more people start acting together to circumvent internal controls, such as the person who orders the inventory, the person who's accounting for it, if they work together, you got a problem. We know top-level employees can override internal control procedures. And again, having effective internal controls are great, but it alone doesn't ensure even survival of a company. So many more factors that come into play. Everyone in the company has an impact on the operations and effectiveness of internal controls, but who must take the final responsibility? Ultimately, the people who run the company, the top executives. Okay, so here for each scenario, we're going to look at various control activities and see what's being violated. Control activities, separation of duties, physical controls, proper authorization, employee management, reconciliations, and performance reviews. If there was no activity violated, state none. So guys, I'm going to give you about 2 minutes. I'm going to pause the recording. I'm going to give you about 2 minutes, or I'll just mute it for a minute, and we'll come back and go through it. So I want everyone to look at this. Okay. Okay, guys, who wants to take number 1? Anyone? A manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production.
Performance reviews.
Would this one be physical controls?
If you are talking, we can't hear you. I think you're muted.
Guys, I'm so sorry. Thank you. Let's go back to, let me go back here. So the first one, performance reviews. A manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production. Performance reviews. Next, physical controls. Separation of duties. At the end of each day, a single employee collects all cash received from customers, records the total, and makes the deposit at the bank. Well, there should be separate individuals to handle each of these jobs here. At the end of the year only, the company compares its cash records to the bank records of cash deposited and withdrawn. They should be doing this monthly. Reconciliation should be handled at least monthly. The company encourages employees to call an anonymous hotline if they believe other employees are circumventing internal control features. Well, there aren't any control activities in this that are being violated, so it would be none there. What about this one? All employees have the authority to refund a customer's money.
Proper authorization.
Excellent. Not all employees should have that authority. There should only be specific individuals at play here. So guys, cash. This is the one asset that needs safeguarding. Cash can be in the form of a variety of items. Cash can be coins and currency, checks received, money in the savings account or checking account. Cash can be credit card sales, debit card sales, or any types of cash equivalents. All of these come into play to determine what we would show on our books as the total cash balance. Which of the following would not be considered a cash equivalent? I'm going to tell you now, cash is a current asset. A certificate of deposit would not be a current asset because it matures over 1 year from now. So everything else would be cash, But the CD that would mature in excess of a year would not be a cash equivalent, just so you know that. Now, let's talk about controls over cash receipts and controls over cash disbursements. Each day, one employee should open mail and list all the checks that come in. Each day, a different employee should deposit the cash and checks into a bank account. As soon as possible, another separate employee should record the cash receipts in the accounting records and accept credit cards or debit cards more often. So you limit the amount of cash that's handled. I mean, guys, in a lot of companies now, they don't even allow cash. You have to use a debit card or credit card to purchase items. I know on airplanes, they don't even allow cash anymore. Controls over cash disbursements. Disbursements should be made by check, debit card, or credit card. Authorize all expenditures. Authorizing employees should not also write the checks. Checks should be serially numbered and should require 2 signatures for large amounts. Periodically agree that the debit and credit card statements match to purchase receipts. Set maximum purchase limits. And ultimately, cash disbursement duties should be handled separate from cash receipt duties. Those individuals in control of disbursement should not also be in control of cash receipt duties. So the big piece with this week is learning how to reconcile a bank account, a bank statement. The balance of cash that's being shown in the company's records may not equal the balance of cash in the bank's records, which is why we prepare a bank reconciliation, because it matches the balance of cash in the bank with the balance of cash in the company's own records. Often, why they're different only has to do with timing. So the company may have items in their records that the bank does not yet have, or the bank may have items in the bank statement that the company has not yet recorded. It's all about timing. So we're going to look at a bank statement. You see on this bank statement, it shows the bank balance to be $4,100. Okay. But the company's activities show an ending balance of $2,880. So cash transactions that have been recorded by the company, but not yet recorded by the bank, we need to reconcile. So things such as deposits outstanding. So the company's recorded it, but it has not hit the bank yet. And checks outstanding. Checks the company's recorded, but have not cleared the bank yet, need to be reconciled. So here you see deposits, cash receipts by the company. We see the March 5th, $3,600 receipt hit the bank. And we see the March 22nd, $1,980 deposit hit the bank. But do you see this sales receipt of $2,200 that happened on March 31st has not yet cleared the bank? That is what we call an outstanding deposit. So we'll have to show that in order to reconcile our bank statement. Now, you see checks that were written by the company that have not cleared the bank yet. We see check 293 for 2,100 cleared the bank. We see check 294 is listed for 2,600, but it cleared the bank for 2,900. So chances are the company made an error when they recorded that, put it in as 2,600, but in fact it's 2,900. So we're going to have to correct that error. And then check 296 for 1,900 cleared the bank. But we've got two checks here that are still outstanding. Number 295 for 1,200 and check number 297 did not clear the bank yet. So we're going to have to reconcile those. So what we do, per the bank's cash balance, we show the deposits that were outstanding, and then we subtract the checks that are outstanding. So we ultimately, the bank balance per reconciliation here is 4,200. Now we need to look at the company's cash balance. This would be, reconciliation would occur because we're going to look at transactions that were recorded by the bank, but not yet recorded by the company. So this would be collections made by the bank on the company's behalf, or interest earned on average daily balances. Items the bank would show that decrease the company's cash balance would be NSF checks, checks that were given to be deposited by the company, but then didn't have enough funds, which we call bad checks. So they come back through the bank as NSFs. Debit card purchases may show with the bank, but not yet the company. Electronic funds transfers and bank service fees. So if we look at the bank and we see a couple items here, there was interest of $200 we recorded. The bank shows on March 31st. We need to record in our books. It also looks on March 9th, they received a $3,000 note, and $200 of that $3,000 deposit is due to interest. Then you see here items that we need to subtract on the company's records: an electronic funds transfer of $400, an NSF check on March 22nd for $750, a debit card transaction of $200 on March 28th, and then a service fee, bank service charges on March 31st for $50. So we need to take these and reconcile them to the company's balance. Remember that one check that we showed for $2,600 on the company side truly was $2,900. So we're going to need to correct that. So here you see the note received of $2,800. 200 of that, $3,000 was interest. We need to show $20 of interest earned on the bank. And then our subtractions involve an NSF check of $750, debit card for office equipment of $200, electronic funds for advertising, $400, a service fee for $50. And we need to then correct that one check we showed was 2,600 when in fact it was 2,900. When we adjust the company side, we end up with a company balance per reconciliation of 4,200, which is the exact same amount we show on the bank balance per reconciliation. This, guys, is how we go about creating a bank reconciliation. This is really important. And guys, I would take a picture of this or write it down so you understand how we're going to go about completing a bank reconciliation. On the bank's balance, we're going to start with the balance on the bank statement, and we're going to add deposits outstanding and subtract checks outstanding, plus or minus any errors that the bank did. On the company's cash balance, we're going to start with the ending balance on the company's books. We'll add notes or interest received by the bank. And then we'll subtract any NSFs, unrecorded debits, unrecorded EFTs, and any bank service charges, plus or minus any company errors. Ultimately, we should balance when this has occurred. So guys, which of the following items would be found on the bank side or the left-hand side of the bank reconciliation?
Deposit outstanding.
Excellent. Okay. How would an NSF check from a customer be treated on a bank reconciliation? We would deduct it on the company's side. Okay, so sometimes students think that an NSF check is a bad check that's written by the company. But guys, that's not an NSF. An NSF check is a bad check that was written to the company. When an NSF check occurs, what happens is the company has deposited a customer's check, but the customer didn't have enough funds to cover the check. So the company must adjust the balance of the cash account downward to reverse the increase in cash it recorded at the time of the deposit. Okay? Then look at items used to reconcile the company's cash balance. We debit cash for items that add to the balance, and we credit cash for items that subtract from the balance. So in this case, based on our previous example, we debit cash for $3,020. Remember, $3,000 was the note, 20 was extra interest, and we'll credit the note receivable of $2,800 because now we've received it. We'll credit interest receivable from the note, and we'll credit interest revenue from the bank account of $20. Items that decrease our cash, we'll debit our accounts receivable for $750. We'll debit, okay, and that was the NSF. So that's why we have to show we are going to plan on receiving that again. We'll debit our equipment of $200, debit advertising expense for $400, debit service fee expense for $50, and debit our rent expense for $300 and ultimately credit our cash for $1,700. So if we receive an NSF check, how would an NSF check from a customer be recorded? We would debit our accounts receivable and credit cash because we initially thought we had received it, but since it's not any good, we need to receive it again. Debit our receivables, credit our cash. Some students try to update the cash account for deposits outstanding, checks outstanding, or a bank error. Company doesn't need to adjust for those items related to reconciling the bank's balance because they've already been recorded in the company's books. That's why we have to put them over on the bank side and show the adjustment there. Okay, so guys, the Spielberg Company's general ledger shows a checking account balance of $22,970 on July 31st. The July cash receipts of $1,885 included in the general ledger are placed in the night depository at the bank on July 31st and processed on August 1st, which means they didn't clear the bank. The bank statement dated July 31st shows bank service fees of $55. The bank processes all checks written by the company by July 31st and lists them on the bank statement, except for one check totaling $1,460. The bank statement shows a balance of $22,490 on July 31st. Here we're going to prepare a bank reconciliation to calculate the correct ending balance of cash as of July 31st. So guys, I want you to take 5 minutes and attempt this. I'm going to turn off the recording and mute, and remind me to unmute. Okay. Zoom recording, and you should hear me now. I just want to confirm you hear me.
Yes.
Yay. So guys, did you have difficulty with this? Is it kind of making sense? So what you'll do is the bank's balance began with $22,490. We add the deposits outstanding, which means they were recorded in the company but have not hit the bank yet. So we show a deposit of $1,885 and we subtract any checks outstanding, which mean they're in the company, but they've not hit the bank yet. So once we add the deposits outstanding, subtract the checks outstanding, we're at $22,915. So in pertaining to the company's balance, we started at $22,970 and we'll subtract the service fees. Those service fees were on the bank statement, but the company has not recorded them. Look, guys, we balance. Our bank balance per reconciliation is $22.19. The company's balance per reconciliation is $22.19. Now, the journal entry that we'll need to record for the company, we always record only those items that affected the company. We will show a service fee expense for a debit $55 and we credit our cash for $55. Remember, we do that because the company has not yet recorded that. So guys, here's another one. Again, the best way you learn is by just going through these scenarios. Excuse me, one sec. High floating. So this one, on October 31st, Damon's company general ledger shows a checking account balance of $83.97. The company's cash receipts for the month total 74,320, of which 71,295 has been deposited in the bank. In addition, the company's written checks for 72,467, of which 70,982 has been processed by the bank. The bank statement reveals an ending balance of 11,727 and includes the following items not yet recorded by Damon: bank service fees of 150, note receivable collected by the bank of 5,000, interest earned on the account plus from the note of 320. After closer inspection, Damon realizes that the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another customer's account. The bank agrees to the error. Prepare a bank reconciliation. So again, we begin with the bank's balance and then the company's balance. So we see the bank's balance of 11,727 shown here. The company's balance, 8,397, as shown right here. So we look and see the deposits. It says the total deposits the company recorded was 74,320. But what was deposited in the bank is only 71,295. So that difference of 3,025, we need to add to deposits outstanding. The company's written checks for 72,467, but 70,982 have cleared the bank. So the net difference of 1,485 needs to be subtracted here from the bank's balance. Remember, it's something the company's already recorded. The bank, it hasn't gone through the bank yet. Then there was an error of $300 they accidentally took from this account. We have to add it back because they did it in error to come up with the bank balance. So for the company side, the note that the bank received, we have not recorded yet, is $5,000. We'll add. The interest of $320 we add. And the service fees of $150 we subtract. Do you see how we balance? So then we'll only take the items we adjusted on the company side and create journal entries. So we'll debit our cash and we'll credit the $5,000 note receivable and credit the interest revenue of $320. The other thing we'll do is our service fee expense of $150, and we'll credit our cash there of $150. Does anyone have any questions on this? Is it making sense? Okay. Now, oftentimes companies keep a petty cash for small purchases. So basically, in the accounting for it, we establish it initially and then we replenish it. So establish a petty cash fund, we would just debit our petty cash and credit our cash. And then as items are utilized through the petty cash fund, we're going to need to record those to replenish. So as you see, monies handled through the petty cash fund was a lunch and a delivery. The purchasing manager used a credit card for supplies, and the marketing manager used a credit card for some items. So what we'll do is record the entertainment expense here of 60, the delivery expense of 90, debit supplies of 1,400 here, debit our advertising for 1,500 and our postage for 1,200. The petty cash was reduced 150. And the accounts payable will show 4,100. We owe that money against our credit card. Okay. When we replenish it, we will debit our petty cash for 150 and we'll credit cash from the checking account for 150. So we can replenish it to that $200 balance we like to keep. Now, guys, we've brought up the statement of cash flows just a little bit, but when we begin talking about this, another financial statement, we talk about a statement of cash flows. And basically, the statement of cash flows shows cash receipts and cash disbursements that occurred during the year or during the period. We know our balance sheet will show our ending balance of cash. And the statement of cash flows will also show the ending balance of cash. Our statement of cash flows breaks down our activities into 3 separate types of activities. One is operating, one is investing, and one is financing. The operating activities are going to cover most of the transactions of a company. So the operating activities involve anything to do with revenues and expenses, pretty much why the company is in operation. Okay. Now, the investing activities only involve the purchase and sell of long-term assets and investment securities. That is it. If you purchase land or if you sell land, if you purchase equipment or sell equipment, if you purchase cash or sell cash, only using cash. Financing activities involve borrowing and owner investment. Anything to do with common stock, paying dividends, or borrowing money from a bank, the only things that are going to go into financing activities. Taking out a loan, paying back a loan. Issuing common stock, paying dividends. In the future, we'll talk about something called treasury stock, where we purchase back stock in the open market, but we're not going to talk about that yet. This is another really important slide that keep track of. Write this out, keep it separate so you can look at this when you're dealing with the statement of cash flows. So we have a list of various transactions, and basically we need to look at, was cash involved in this transaction or was it not involved in this transaction? And we show what type of activity it is. So when we sell shares of common stock for $25,000, that's a financing activity, because financing is anything to do with issuing stock and taking out a loan or paying back a loan. Was cash involved in this? What do you guys think? Yes, it was. When we borrow $10,000 from a local bank, that's to do with borrowing money. It's a financing activity, and cash was involved. When we purchase equipment for $24,000 for cash, yes, cash is involved. That's an investing activity. the purchase and sell of long-term assets or investing securities. When we pay 1 year in rent in advance, cash is involved. It's why the company's in business, it's operating. When we purchase supplies on account, cash isn't involved there, guys. We bought them, we haven't paid it yet. That would not be part of the statement of cash flows. When we provide golf training to customers for cash, yes, cash is involved. But when we provide golf training to customers on account, cash is not involved. We have not received the money yet. So it's important for you to become aware of any transaction. What type of activity is this transaction? And does it involve cash? So here is how we break down these transactions. Cash inflows from customers will go in operating activities, transactions 6 and 8, when we provide golf training to customers for cash and when we receive cash in advance. The 4,300 and the 600 would show here for 4,900. Cash outflows for salaries, 2,800, for rent, 6,000, would be our transactions involving operating activities, total of 3,900. Cash flows from investing activities only relate to purchasing equipment for cash. Financing activities involve issuing common stock, taking out a loan with the bank, and paying dividends. Do you see, if we take all our balances here, our minus 3,900, our minus 24,000, and our 34,800, we end up with an ending balance. That will also be our ending balance on our balance sheet for 6,900. Guys, which of the following items would be categorized as an investing activity on a statement of cash flows? What do you think?
C.
C, you believe, is the correct answer. Excellent. Investing is when we purchase equipment. Now, assess cash holdings by comparing cash to non-cash assets. Here, we're looking at comparing Regal Entertainment to a similar company in the same sector, Cinemark. If you look at Regal and Cinemark, you see Regal's entertainment cash was 147, Cinemark is 638. The non-cash assets for Regal, 2,392,000 or millions, and Cinemark 3,513. So to compare the ratio of cash to non-cash, take the 147 divided by the 2,392, you get a ratio with Regal of 6.1, Cinemark a ratio of 18.2. Okay, then as you look at operating cash flows, you see throughout the years, Regal Entertainment's sitting right at 346 to 349, and Cinemark's gone anywhere from 395 up to 454. Having too much cash can represent idle resources. That is true, guys. One way to assess cash holdings is to compare cash assets to non-cash assets, which is true too. And in recent years, cash holdings have increased tremendously. Basically, guys, all of these are true. I'm not going to worry about this one. Basically, this is recording the transactions and then going through the whole process of showing the cash balances and creating a statement of cash flows. You can look at that. But guys, this is clearly an easier chapter than what you have worked with before. I want you to take a look at I'm going to just show you kind of some examples that will be on the quiz so you're aware. Let's find this. Why can't I? Oh boy. I don't know what I'm doing wrong. There we go. Okay. So here, as we look at our quiz, Chapter 4 quiz, know that a company establishes a petty cash fund for $440. By the end of the month, employees have made the following expenditures from the fund: supplies, fuel, postage, miscellaneous. Record the entry to recognize employee expenditures from the petty cash fund. Pretty simple. Next one. Boy, oh boy. Next, here is a petty cash. The funds replenished it each month. In addition, the company's issued credit cards for substantial employee purchases. These credit cards are issued to authorized managers, and they show the petty cash fund and items for the credit card. You need to show journal entries recording the establishment of the petty cash, recording the expenses that got paid out, first for the petty cash, and then number 3, the employee expenditures. Then you'll record journal entries here regarding cash. Next, a bank reconciliation. Next, another bank reconciliation, along with journal entries, a statement of cash flows you'll need to do. And again, guys, the key is knowing, first of all, is it cash or is it not cash? And secondly, what section does it play into? Anything regarding why the company's in business is going to be operating. But you see here, sale of unused office furniture, that's equipment. That would be investing. Borrowing money from a bank is financing. Paying dividends to stockholders is also financing. then you'll have some multiple choice. So guys, it is definitely easier than what you've been through in chapters 2 and 3. You're learning about cash, which is why we're bringing in the statement of cash flows. And then also we're talking about the bank reconciliation. Are there any questions you have before we end it for today? Anybody? Well, guys, have a great week. And remember, we will be back in class next Wednesday. Okay? Have a great week, guys. Bye-bye.